One of the key strategies for long-term success financially is to have good tax planning, right? It's not year to year, it's looking over the long term. Well, there's a term, tax bracket equilibrium, that you may or may not have heard of, but today we're going to break down what that means, why it's important, how to apply it to your portfolio and your plan as you move forward, and give you some strategies you can take away. That's coming up next. Hello, welcome in. Glad to have you back on Retire Right. This is a Wyze Wealth Advisors podcast. I'm Ben George with Ryan Wyatt, who is a wealth advisor, certified financial planner as well. I don't think, Ryan, I've done a lot of conversations about taxes over the years, but I actually don't think I've ever heard tax bracket equilibrium. Is that something exclusive to you guys? Because I feel like that would have stuck with me a little bit more than if I would have heard it before.
No, I don't think it's specific to our firm. I wish that I could take credit for that, but I don't think it's specific to our firm. But it's certainly a strategy for our clients that we are constantly trying to help them achieve, because it's just from a long-term tax planning standpoint, it's just it's the optimal way to do it. And I know, of course, we're gonna actually explain what that means, but
Yeah, it's interesting. I like the term. I think I get the idea behind it, but I don't think I've ever heard it phrased like that, which is great. It's easy to remember, and it kind of paints the picture for you. But again, if you're just joining us, please hit subscribe on the channel. We appreciate your support there. Wyze Wealth tax planning is one of the key pillars for them, so that's why we want to kind of get into this a little bit more today with tax bracket equilibrium. We kind of break it down in a few different sections. We're going to give you an overview first. Talk about how do you determine that equilibrium that you're searching for. How poor planning really can hurt you down the road, and some strategies again to take away from this episode that maybe you can apply to your plan. So Ryan, let's jump in with just kind of an overview of what that finding, that tax equilibrium looks like. And again, as we always talk about, why this matters.
yeah. So what we see all the time is that people essentially become too good at deferring taxes. And what I mean by that is maybe they've held equity or stock positions for long periods of time, and when they go into retirement, if they need to touch those assets to supplement income, there could be really large gains that are subject to taxes as part of that. And that's obviously a good thing to have. Your positions have grown, but there's an embedded tax cost there that we like to help plan around. Another thing that we frequently see is that a large part of people's savings are put into the retirement accounts. And, the way that that's working is that, say you have a 401k with all pre-tax money, so no Roth in there at all. Well, you just deferred that income today so that in retirement, when that money is pulled from that account, it's taxable as ordinary income then. And of course, the more you save into your 401k, that asset base can grow and grow and grow. And eventually later on in retirement, when that money is forced by the IRS to be taken out, there's a calculation for that. It's called mandatory distribution or required minimum distribution. That's all taxed as income. And that can actually push people into pretty high tax brackets later on in retirement. Did that answer the first question? I'd want to maybe just define what equilibrium means, but I want to make sure that I answered the first question there.
Yeah, essentially, it makes sense because you don't want to be too heavy in any of the tax buckets, right? So it's about finding kind of that balance, and it's great to defer taxes, but as you point out, being too good at it could really harm you down the stretch.
Yeah, and that's basically in a nutshell what equilibrium means.
Okay.
I like to say, think of a seesaw. You could be really low on one end and really high on another end, or vice versa. You could have really high income now, be in a very high income tax bracket now, and then depending on the strategy or approach that you took, you could be in a very low income bracket later on. What makes the most sense to do is try to find that balancing point where you level out your taxes and try ideally to stay in a consistent bracket throughout. If you can do it for your whole kind of working career, great. and into retirement, but at least when you enter into retirement, trying to stay in that level tax bracket. That's the ideal way of doing it. And
Okay.
that's what equilibrium means.
All right. So we want to find that balance. So let's talk about how you do that then at Wise Wealth. How does your team then, Ryan, begin to kind of map that out and figure out, okay, where's that equilibrium going to be? What is that tax rate going to be to find that balance to make sure that we are distributing this money as tax efficiently as we can?
Yeah. So, I mean, when we're putting together a financial plan for a client, obviously we're identifying what those known income streams are. So that would be things like Social Security benefits and pensions. Of course, with Social Security benefits, we'll put what the benefit is in today. We'll put, some sort of assumed long-term inflation rate in there. Same thing with pensions. Do they have an inflation benefit or not? But we'll find out what those known income sources are first. Then what we'll do is we'll look at their pre-tax or their qualified retirement accounts, and we'll begin to estimate what those mandatory distributions will be, based on when they have to start those, either 73 or 75. And we'll literally project those withdrawals to kind of start getting an idea or a stable picture of what their income is going to look like long term. We take it a step further. We even look at their non-retirement accounts, and we try to estimate the investment income that can be generated from their non-retirement accounts. So that could be things like dividends, interest, capital gains, etc. Once we do that, then we have a pretty good, of course, there's some estimates in there or some projections, but we have a pretty good idea of what their long-term tax picture is going to look like. And it's easy for us to put that in brackets over time.
Are there any limitations to trying to do that? I mean, I'm sure you can forecast it as well as possible, but again, I know that tax rates, we don't know where they're going to be in the future, right? It's important. It's impossible to try to predict that. So, kind of what limitations do you have when you're trying to forecast this out?
You're 100% right. You don't know what's going to happen. What tax law changes are going to be implemented or not. So that is always an unknown, which is what makes this more difficult. I know, for example, right now we are assuming that tax rates do sunset and increase. And then in addition to that, you have to start getting into, based on how a client's portfolio is allocated, meaning how much they have in risky investments like stocks and how much they have in more conservative investments like bonds or cash. You have to also use some growth assumptions on those investment portfolios so that you can kind of project out how their investment accounts grow over time, and then project the distributions on those asset balances over time as well. So again, there's some projections going on there. We're very comfortable in our assumptions, but there's definitely some projections going on.
Okay. Well, let's talk about then with planning. I know, sometimes people can be too tax efficient and just not plan properly, right? A lot of people try to do it on their own. It can be very difficult at times, but how can poor planning lead to potential tax issues down the road?
Yeah. And I don't know. I think it's fun. I think it's funny. Like, you hear the word too tax efficient, and you're like, well, how can that be a bad thing? And what I always say is, think about somebody that retired at, let's say they retired, they're 65.
Okay.
And based off, the new mandatory distribution rules, they don't have to start taking required minimum distributions until they're 73. What happens is, depending on where their income was at before, say they were making 150,000, maybe their wife was making 50,000, so their total income, 2 years ago was at 200,000. And now all of a sudden, 150,000 of that's gone. So they're just not even getting into where the money's being pulled from in their investment accounts. If you just look at the income, they have dipped down significantly. And now they're in lower tax bracket years. Again, depends on where money is going to be pulled from to meet their income now that income is gone. But now they're in low tax bracket years. And depending on the strategy that's used, if you use the classic rule of thumb, look at your taxable accounts first and let your retirement accounts grow, because you don't have to touch those. Again, you don't have to touch your traditional IRA that was rolled over from a 401k until you're 73 now. In this example, 73. In a Roth IRA, there are no mandatory distributions on that. So you could even let that grow longer. So if you follow the traditional rule of thumb, maybe you have a lot of cash and you're meeting income temporarily from cash. Well, that's not going to really impact your taxes at all. And then maybe you have some non-retirement accounts that don't have a lot of gains in there. And maybe you go in and you sell and meet your income needs from there as well. And so then what's happened is you went from having 200,000 of income, you're in a higher tax bracket. Now you're distributing very tax efficiently between your cash and your non-retirement account. Maybe you're all the way down in the 12% bracket. Say you stay there for 5 years or so. You've almost been too tax efficient with your distribution because you've neglected looking at those retirement accounts to supplement income. And that's just been growing and growing and growing. So now your mandatory distributions at age 73 are going to be a lot larger than if you were taking some of those distributions while you were in those lower tax bracket years. The simplest way, I know that's a lot, but the simplest way for me to say it is when you retire, if you're in this situation that I'm describing, you could look at those low tax bracket years as use it or lose it years. If you don't fill them up, if you don't realize some income in those lower tax bracket years, primarily in the earlier years of retirement, each year that passes, you may have lost an opportunity to realize income at a significantly lower tax rate than you will be in your later years of retirement.
That makes sense. Yeah, interesting to see how that kind of plays out, and it can be easy to kind of miss those opportunities if you aren't paying close attention. Let's close it out then with some strategies. I talked about this at the beginning. Some strategies that both you and the team at Wyze Wealth will utilize to help people find this equilibrium, and some strategies that people can consider if they're saying, okay, I want to make sure I'm balanced as I can be and find this equilibrium. What are some things that you can do to help achieve that?
Yeah. So, one of the first things is, say you're still working. What we can do is we can look at your where your taxes are at now and where they're projected to be in the future, and we can have a conversation with you around whether it makes sense to do contribute to your accounts with pre-tax money, meaning take that deduction now, or put money, let's say, to a Roth 401k, or based on the income limitations, a Roth IRA. So we can basically make the recommendation to say, does it make sense to realize more income now, meaning put money to Roth, or take that pre-tax deduction, say go into the traditional 401k. That would be one thing.
Okay.
Of course, Roth conversions make a lot of sense. In the last example that I used, they were making $200,000 when they were both working. The husband stopped working. His income was $150,000. Now they have about $50,000 in income and a good bit in cash that they can use to supplement some of those spending needs. Well, then Roth conversions, meaning shifting money from those large pre-tax accounts, filling up those low tax brackets and getting money into Roth where it's not going to have a mandatory distribution. And then later on in retirement, when it is distributed, it's tax-free. That's a great strategy to use. Another thing that you could look at is, does it make sense to actually sell some assets in your low tax bracket years in your non-retirement accounts at a gain? You're basically, harvesting some of those gains, knowing you're taking on a tax liability, but you're in a lower tax bracket year. I'd say those are the three kind of primary strategies we would look at. Of course, there's others, but for purposes of the episode today, I think those are the three that I'd want to focus on.
Okay, so Roth contributions, Roth conversions, and capital gains harvesting, some things to be thinking about. And again, if you want to sit down and look over your equilibrium, look at your tax accounts down the road, kind of see what the projections look like and see what you can do to keep as much of that money in your pocket as possible. Again, wisewealthadvisors.com, great place to start. You can schedule a time to meet with the team there, or call 724-271-7019. And Ryan, just for you, what would you kind of pitch to someone who's like, okay, I don't know that I'm as tax efficient as I can be. I want to make sure that I'm not too far one side or the other. Kind of what would you recommend for someone that's looking to kind of take that next step right now?
Yeah, I would just say, we have a very easy process for you to evaluate our services. We follow a 3-step process. The first step in that process is determining if there's a good fit between what you need help with and our areas of expertise. The second step in that process is we actually take a deep dive. Assuming there's a good fit, we'll go to the second step in the process, and we'll take a deep dive in your situation. We'll ask you a lot of questions, gather a lot of information. That way we can go back to the drawing board and actually put together a retirement plan, investment proposals, and a long-term tax strategy as well. And we do a good job of knowing the questions to ask so we can gather information to really efficiently look at what that long-term tax picture is and address any opportunity areas if we find any.
All right. Very good. WyzeWealthAdvisors.com. Check that out. And also subscribe to our YouTube channel if you haven't done that as well. We appreciate that support. Plenty more content on the way. Questions you might have, we'll try to answer them here in our videos. But any other questions, direct them to the team. I know Ryan and the team will be happy to help you out with anything that you might have questions about, concerns, or just, hey, you want to start planning? Now's the time to do that. So, Ryan, thanks as always for your time. We'll do it again soon.
Yeah. Thanks, Ben. I appreciate it.
Schedule your complimentary review with Ryan and his team today. Just visit them online at wyzewa.com or call 724-271-7019 to get started.
This episode's content is for informational purposes only. Opinions expressed herein are solely those of Wyze Wealth Advisors, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by our firm as to other parties' informational accuracy or completeness. All information or ideas provided should be discussed in detail with an advisor, accountant, or legal counsel prior to implementation.